Get it online tomorrow.
Yeah.
Okay, we're live and recording.
And Richard, do you know Bob?
I don't.
Okay, hey.
Are you? Richard,
Rich is new to the finance committee. Bob, from Great Point, they've managed, several portfolios for us for, it's been a long relationship.
Oh,
right?
9, yeah.
09. It's been a very good relationship.
We feel the same, thank you.
So we appreciate you having here. But first order of business, though, is we're gonna get a motion on the floor to approve the minutes. Motion, please.
I'll make the motion.
Second. Oh, great. Any discussion or clarifications? No. Are there any opposed? Carried unanimously. Great. Next order of business is the financial reports that we were just talking, and Bob's gonna walk us through some of these presentations. And we have a. We're gonna walk through this, or we're gonna?
Yeah.
Okay,
Well, I am.
okay, good. Super.
If you're, would you like me to start?
I'm ready for you. I feel ready.
Thank you, Ash.
Ashley,
Well-
you ready for him to start? Are you expecting big
Are we-
things out of
are
Bob
we gonna-
today? I mean, it's a
Are we
significant.
gonna do this in an executive session or?
So,
Think so.
Okay.
We
All right.
traditionally have not, John.
I know.
It's an interesting inflection point today. As we sit here, the first full day of a new president with new economic perspectives and this and that.
It certainly injects an element of uncertainty, you'd say that.
For sure. That's a good way to think about it. All right.
All right, well, appreciate the opportunity to be here. Thank you. Appreciate this long partnership we've had with you. Thank you for that. Most of you know Alicia Lash, who is my partner in our relationship with you guys. I guess you're not supposed to say that anymore, you people. But she had to go to a funeral on the Cape and regrets not being able to be here. So you get the B team. Here I am. All right, so what I thought I would do is just spend a few minutes with kind of the investment landscape, top down, we call it, as a backdrop, and then get a little bit into the portfolios. And so I'm not going to spend a whole lot of time on each of these pages or slides, but try to hit the high points. Right, so on for page 2, first page, you know, I'm probably not telling most of you anything you don't know, but the economy did slow in the second in 2024. You can see that on the highlighted line, progressively slower growth. It's our belief that we're going to see that low 2% range of GDP growth continue throughout this year, which you describe as healthy, but hardly robust. The unemployment rate, as you can see on the second line, ticked up. It actually ticked down to 4.1 for December. And it's still, historically speaking, quite low. I think the important point to make is that at this point, we don't think the odds of a recession are good at all. Not likely, but you know, you can always find evidence to support any case you want to make. So it's never entirely conclusive, but our belief is we will escape one. You see at the bottom of the page, the index of leading economic indicators has just ticked up ever so slightly.
What are you economists gonna do when you can't say that sustained inversion of a yield curve has led to a recession? Like, what are you gonna be able to say? Because we always look at these charts and say, look, and 70 this and 80 this, like.
Shape of the yield curve, along with the index of leading economic indicators, is an incredibly reliable signals for future economic growth. Having said that, we now have a positive yield curve, as you know. Having said that, it can also be a sign of inflation or stagflation. So again, there's never any certainty.
I appreciate the clarity.
Or lack thereof. All right, or refusal to make a commitment. On this third page, the labor markets have come into better alignment. Job seekers, job openings are about where they should be. As a result, wage inflation has come down. You can see that on the chart. It's the bright blue line. Wage inflation is an important driver of overall inflation. And it's at 3.9%, which sounds higher than inflation. It is, but keep in mind that there is productivity, which means that that's about the rate that's in line with the overall inflation rate. It matters a lot to the Fed, and so you can see the gray line as unemployment, the unemployment rate is ticked up, wage inflation has come down, and that's really all good news for monetary policy. Page 4, inflation overall. The headline CPI continues to come down, and that's the bright blue line on the graph. Core CPI has been a little sticky and it's hard to see, but that gray line has moved sideways a little bit. The Fed's preferred measure is core PCE deflator, personal consumption expenditures, 2.8%. I mean, these are much better numbers than we were seeing at the peak. Page 5, this is the interest rate page.
Just to say though, there's not a indicator here that's it's flat to whatever. It's not.
I'm not sure what you're saying.
October to November. The concern is it's stuck, right? It's stuck at this point.
It has
And that's not
stalled
where-
out a little bit, and that's
And isn't that changing the thesis of kind of where interest rates are going?
yeah, very much. And well, that's one of several important points for why, and which I'm going to on the next slide.
I don't want to get ahead of you. I don't want to get.
You already did. Okay, so rates came down sharply last summer in anticipation of the beginning of a rate easing cycle. Since September, which is when they initiated with a 0.5% decrease, rates have largely retraced their steps and gone back up. A couple of factors: the economy's run a little hotter than expected, inflation a little bit stickier, and probably equally, if not more importantly, is the policy uncertainty in Washington. And so that there was a fairly radical change in the market expectations. Late last year, the market assumed 4 cuts, 0.25% cuts in the Fed funds rate. Now the markets assume 1 cut. So that's pretty radical. And you can see on the chart to the far right, the green diamonds show. And keep in mind that up until now, the market was predicting more interest rate cuts than the Fed itself in their quote unquote dot plot were predicting. And that's the blue line. And so you could see that the market's more pessimistic or hawkish about monetary policy than the Fed itself. And that's, I would say the market's usually more right than the Fed. So, but we'll have to see. Having said that, though, we still see room for rates come down. Certainly not as much or as soon as we had before. By the way, this chart is for the Fed funds rate. All right, now, Treasury yield curve, interest rates. well, there's two blue lines, which is a little bit confusing, but the blue line that says December 31 under it, which is pretty close to current where interest rates are now. You can see that positive slope. In the red circle is 2 years, and the other red circle is 10 years. So you have a 30 basis point differential. So we're seeing a positive slope, which most of the time signals healthy economic growth ahead. And especially when you combine it with rising index of leading economic indicators. The problem is that it may also signal inflation, which, or stagflation, even worse, which for some of you remember the late 70s. It's not a good environment for interest rates, but it's far too soon to be concerned about that. It's just that the shape of the yield curve is not 100% signaling one outcome or the other. But overall, we're optimistic. The economic growth will continue and rates will come down modestly. So now I'm going, although the equities in your reserve account are a fairly small allocation, they've actually been a really important allocation, and we'll see in a moment that they've added a lot, even at the low allocation. So I'm going to just say a few things about the equity markets, which I think are important. Corporate earnings growth and what investors are willing to pay for that growth, otherwise known as price earnings multiple, valuation metric, really over the long term drive interest rates. Stock prices. And the estimates for 2025 are strong, and you can see that in the upper right. There's a box that illustrates the expectations for each of the quarters this year, and you can see that they go from 11% up to 17%. So increasingly strong corporate earnings growth expected. And so where we end up is that, or I would say, however, maybe a better way to put it, the valuations are stretched. And you can see that in the chart in the lower left, which traces the forward-looking price earnings multiple. That means it's the E part of price earnings is based on expectations for the following 12 months. And at the end of the graph, where we are now, the price earnings multiple is well above average, 1.4 standard deviations above average. So overall, the S&P 500 is overvalued. And so on the next page, kind of look at what's causing that overvaluation. Starting on the left-hand part of the page, that graph tells the tale of two markets. The green line, which clearly dominates the other two lines, is made up of the so-called Magnificent Seven, or Mag 7, which are the 7 large mega cap, mostly technology names, including the usuals, and NVIDIA, Meta, Alphabet, and so forth. And you can see it's pulled up the gray line, which have done extremely well. The S&P has done extremely well over the last 2 years, but the action is in those top 7 stocks. The blue line, the poor suffering other 493 very pedestrian names have done less well. Now, looking at valuations, if I could if I could point you to the upper right-hand part of the page, not totally apples to apples comparison, but these are the top 10 names in the S&P 500. the top 7 make up over 90%. So it's a pretty good analysis. Here we look at the percentage of the average valuation as measured by price earnings multiples. And you can see those top 10 stocks, if you read the chart, are at about 1.5 times average the lot. And the market itself about little over 1.25 times, and even the remaining stocks are somewhat undervalued, 115% average. And if you look at the lower right-hand part of the page, that shows the concentration, the amount of the market value of the S&P 500 that is constituted by these top 10 stocks. It's almost 40%. It's unprecedented concentration, and concentration at that level adds potential volatility, which is really the definition of risk. So it would be fair. Well, we have 2% of the names in the S&P 500 making up 40% of the so-called market capitalization. So it's our conclusion that it is simply not prudent to model a portfolio after the S&P 500. A couple of things. We serve as fiduciaries to you and these funds. You're in the business of economic lending for economic development, not in an investment fund. And so we have the weight of these top stocks dialed down to 50%. We don't want to be 0, but we certainly don't want to be at a full market weight. We perceive it too risky. Yes, it's provided some. It's provided some headwinds to the performance of the portfolio, and we'll get into that in a moment. But it's our belief that it is the right thing to do, is to reduce risk, not take risk, especially given your circumstances. You may need these funds. The next chart on page 9, I'm not going to go into it. You've probably all seen the so-called quilt chart. It just shows over the last 14 years which segments of the market have performed the best and which have performed the worst by year. And the only reason I show it to you is simple observation about the markets that if you hang around long enough, you'll see, and that is that the last shall be first and the first shall be last. My only quote from the Bible today.
So far.
So far. So the point is, we don't know when these top 7 or 10 stocks are to come back to earth, but they will moderate in due course. You can look at history and it becomes obvious. Do we get a 3rd year of outperformance from these names? We'll have to see.
Where's Bitcoin on this? Where's the Bitcoin? Where's BitDog?
I don't know that there is a box for Bitcoin.
I know there's not, but if you put it in, it'd be on top.
I guess so. Is that an investment?
No, you're going to quote the Bible. I can do my own too.
You're the chair. You can do it. A quick comment on international equities. Start quickly on the right-hand side of the page. I mean, you can see clearly that for any period, 4th quarter, year, 10 years, domestic equities have totally dominated international equities, both developed and emerging markets. And some of that year to date and quarter to date is the performance of these so-called Mag 7, but not for 10 years. And it's more than doubled international. And the reason that we believe this performance has been superior for the domestic stocks, and the reason why we continue to have such a low international weighting is that we think that the best earnings growth will continue to come from domestic companies. And if you look on the left-hand side of the page, you can see how dominant, other than China, which who knows if their numbers are legitimate, for a time, other than China, the US growth has dominated global growth, and US is the gray line, and you can see the others. And so it isn't just that we expect corporate earnings growth domestically to exceed internationally. It's also the case that international stocks are more volatile, therefore more risky, and we don't need the currency risk. So we have globally, there 35%, roughly 35% of the global capitalization are international foreign stocks. We have about 5%. Some of the larger endowments and foundations, which you're not, do have a global allocation. We don't, even for our endowment clients. We're about 5%, and you'll see that momentarily.
This slide on page 10 on the left, one thing that always strikes me is, you know, you look, you highlight the recession or the recessionary times in gray, right? And you have this incredible period of no recessions, right? And then you look at the moments you had, they're kind of exogenous events, because you had the mortgage crisis of the Great Recession, and then you had the pandemic. I mean, so it's almost like steady state economic conditions are so managed that it eliminates almost, or mutes, this whole concept of a recession. But for these things that you can't plan for.
I wouldn't go so far as to say that the economic cycle is maintained, but it isn't what it used to be.
I mean, if you go back, I mean, you'd see these gray bars,
Right,
like every
4 years or so.
Yeah.
With the cycles that we've had in modern history have been much longer. I mean, we didn't even have a Fed until what?
There's been nothing like this era.
No, it's been incredible.
What does EM stand for?
Emerging market.
Okay.
All right, I'm not going to say too much of anything on page 11. That's just a summary. You can look at that if you wish. I would like to talk about the portfolio. It's mostly fixed income. You know that. That's appropriate. It should be. But just because the equities have played such an important role, just a quick comment about where we are. The portfolio is positioned for continued economic growth, and you can see that on that half circle. Cyclical growth is the way we have the portfolio position. About just a little over 80% of this is the circle graph, is in large domestic equities, and about a little under 20%, which is the lighter blue, is in segments that kind of broaden the portfolio out. And that's the part of the portfolio that for most of the last 2 years has been a little bit of a headwind, as the Magnificent Seven stocks so dominated the equity markets. The rest of the markets, small cap, mid cap, anything that wasn't one of those names lagged. And so we believe very strongly in diversification as a long-term risk reducer. And so that part of the portfolio is important. Actually, between July and November, it actually outperformed the large cap or large company stocks, but December gave a lot of that back. And the bar chart at the bottom shows what those allocations are. Developed, international, mid, small size company stocks and regional banks. So the comment about fixed income, since that is the majority of your portfolio that, finally we have attractive rates. We're not dealing with 0 or 1% anymore. And so that's a very favorable scenario for these portfolios. It's our, to the extent that we can extend the duration a little bit, we'd like to lock in these rates for as long as we can. We know there's a limitation. These funds we know we have to avoid any meaningful amount of interest rate risk. But the so-called terminal Fed funds rate, the rate at which the markets and the Fed itself think that the Fed funds rate will land at over the period ahead, ranges from about 3%, is in the 3 to 4% range, in the 3% range, 3 to 4%, with the Fed a little lower than the markets. So if you were just say 3.5%, that's a whole lot better than when we were struggling with very low rates, which was a real headwind to the absolute returns on these portfolios. We don't have that anymore. And even if we have to stay short, and we do with a significant part of the portfolio, we're still getting good rates.
Do we have policy on duration in our fixed income?
Yeah, you do.
What is it?
Written down here. It's the weighted average maturity has to be less than 4 years. It's a little over 3 at the moment.
Okay.
And we need to have 25% of the portfolio less than a year.
Yeah.
We have 32%. So we're you'll see in a moment we're lined up with the policies. And so then I go to page 14, which is the reserve portfolio, and there's a few things at the bottom of that graph that the top that I'd like to just touch on. Generally, I would say that the returns from the portfolio based on the policy benchmark, which is the first blue line, which is 7% equities and 93% 1 to 3 year government credit, which is a high grade short-term bond benchmark, are generally close, a little bit behind, and that is really caused by our conservative nature, the nature of these funds, the nature of our fiduciary responsibilities. And so since we started in 2009, they're right about the same. But that's not a very exciting return, 2.5%. And that's because rates for much of this period have been so low. I think the most important point that I'd like to make is the second blue line, which is, what if you didn't own any equities ever? What would it look like? And if we go back to the beginning, you're getting almost 1% every year on average, compounding more return in every period, except for the last quarter. In every period, the returns from the portfolio have been well in excess of, actually last 3 years, been right about the same. But in every other period, the portfolio has benefited from the inclusion of a relatively modest sleeve of equities.
What line are you looking at?
The bottom blue one,
On page 14?
14.
Bloomberg versus,
Do you, yeah,
The gray one?
well, the two top ones, all right, the first two gray ones are gross and net of fees. That's your portfolio performance. And then there's two blue ones. The top blue one is your policy benchmark.
Yeah.
And then the bottom blue one is basically what would have happened if you
We had
were,
no equity.
if you had no equities. So even though, and you'll see in a minute, the equities have had the headwind of our conservative nature, but they've still added value to the
What
portfolio.
if we had it all in equities?
We'd be in violation of our,
I understand.
That probably was the
theoretical.
excessive risk.
What if?
You would have done a lot better, needless to say.
Yeah.
But we have to be prudent, right? The chart on the bottom, the line graph, it doesn't say much. It just says it's a good idea to invest your funds and not keep them in the mattress. And when we look at the liquidity portfolio next on page 16, and here we have it's an extremely low fee if you're wondering why the gross and net of fees the same all the way out to 3 years. It's just because I think it rounds to one digit. And the reason why it's dominated US Treasury bills is because we have higher yielding investments than US Treasury bills. US Treasury bills have been a pretty easy benchmark to beat, which is why we chose it. That's not why we chose it. It just seemed like the right benchmark since we're very short. No risk at all in this portfolio.
What's
No
our average
meaningful
life
risk.
in this one?
Pardon?
What's our average life in this portfolio?
It's 0.4 years. This was from, if you might recall, I'm sure you do, I think this money was sitting in the bank. And you said, can you do better? And we said, probably. So this wasn't ever meant to take on any amount of investment or interest rate risk.
Yeah.
And in fact, you took a big distribution. But the way that, well-
As a reminder to pay for the 30K Hamilton acquisition.
yeah, thank you, Ashley. So, if I'm only going kind of fast because I know I'm not the only thing on your agenda. The page 15 digs a little deeper, and I really don't want to go too much deeper unless you want me to. But the asset allocation chart in the upper left, you see you got 11.1% in equities versus 7%. That has helped the components of the portfolio, the fixed income portfolio are below that. You can see we're very heavily weighted towards government securities, a little bit of corporates, a little bit of CDs, but taxable munis, but heavily weighted towards government securities for safety. The duration is just a little bit higher than the benchmark. And you can see down at the bottom of that, just under that section, average coupon 3.4, because it's treasury bills, so you have an average yield of 4.3, pretty good, very high average credit rating. And then there's an attribution in the upper right. All that it says is in the top section, you benefited from having a higher equity allocation than the benchmark, slightly higher. And in the next section, that the individual domestic equities in the portfolio were a headwind because we didn't have a full allocation to the now intensely overvalued Magnificent Seven. And the rest is pretty much in line. This is really short period, quarter to date, 12 months. Fixed income a little behind because rates went up in the last year and net and a little bit longer duration. And underneath the investment guidelines, and we put that there to make sure that you can see that we're in compliance with your investment policy. Obviously, the investment policy statement's a lot longer, a lot of other nuances, but these are the key components of it.
Can I ask questions? Our investment guidelines for the reserve portfolio, are they not the same for the investment guidelines for the liquidity portfolio?
they're not
We have a
the same.
different, okay,
Yeah, there's a little bit more latitude with the reserve portfolio than there is with the liquidity portfolio. The way they're written today. And I'll just finish up on page 17. There's really not a whole lot to say. This is the liquidity portfolio. Short, again, mostly dominated by governments. A little bit lower yield to maturity, shorter, high quality. And there's a brief summary of the investment guidelines on the right. And that's all I had prepared, but I have
what do you think about, because every time I look at this, I have the same reaction of, we have investment guidelines overlaying all our investments, but I feel like we're never looking big picture holistically at all our, like, if we have a set of guidelines for the reserve portfolio, and then we have a set of guidelines for the liquidity portfolio, you know, we're not really, if it was my household, I'd be looking at this and saying, well, I have my liquidity portfolio in very conservative, low interest, like risk averse stuff. Why am I not taking that into consideration when I look at the rest of my portfolio in terms of my 15% equity allocation? So if I have $1.6 million sitting in a highly liquid conservative investment, and I added that to my reserve portfolio in the aggregate, I would have more, I would have more money to invest in equities, essentially.
well, I mean, I may not be the right person to answer that. It's kind of philosophical. I mean, it's very easy to have another report that consolidates them.
That would actually, that would be really helpful.
That'd be helpful.
Yeah.
Because we also
I don't
have,
agree with John, but I
That's
think
fine.
that'd be helpful.
well, we also have other assets on
Right.
top of what Great Point has. So we have other funds in equally, you know, perhaps even more conservative,
Sure.
that we are sitting there. When you look at our equity allocation in
Maybe.
the context of $10 million of investments, we would have,
Well, only counterpoint, and I'm not trying to argue one way or the other because it's not my place. But a counterpoint might be that each of the portfolios has a purpose and therefore needs to stand alone. And again, that may not be the way the committee and the board would want to look at it, but it just pops into my mind as a possible. Understand what you're saying, and it would be interesting to look at, and we'll at least look at it.
I think it'd be interesting to look at, and Andy, maybe you should think about also injecting kind of a view of the other funds that we hold that are liquid assets that are in banks throughout the capital, and kind of look at that in the aggregate so we get some perspective. But I would think that statement is correct, that these funds have specific purpose.
and we could even,
But we also are.
in our graphs, if you were gonna do this in like a chart or graph form, color code it to say, yeah, well, that's liquid, but we have it has a designated purpose, so we need it to be liquid. And if you start looking at the chart and everything's essentially,
Everything we have is liquid. Just the question is how much volatility it has.
and how much, or do we need in the next how much of that in the next 5 years are we gonna need to spend?
Well, a legitimate conversation, which we've had multiple times, is about the reserve account, that we really don't take much. And then the question is really, how much might you need at any given point in time, and how much is more bedrock. And it's really that bedrock component where we're able to take more risks, like the equities, maybe longer bonds. And it's the definition of, it's that bedrock component that is so hard to define, because so you're here really for economic development, to give, fund buildings, buy buildings, make loans on buildings, where I assume they're not really bankable in the mainstream. And what happens if there's something huge that comes down the pike and you need it all? And
Like you could own a bus station. You could be the proud owner of a bus station. I think there's a couple points to it. I think, yes, there's that. There's the other thing is we comply with the public authorities law, which a lot of things is, it's not our money, it's the public's money, it's there for public purpose. And to take trading risk on public funds is inappropriate. I think
But
it's.
if we have a portfolio, if we're saying we only want to put 15% of our portfolio of assets and equities, I feel like I've always thought we should be looking at our entire portfolio of assets.
We can do
when we
that.
make determination.
That's fair. Don't forget, you're also taking a huge, so that whatever thesis there is in these initial economic things is this higher for longer construct is kind of where people are at. And if that's the case, then you can get riskless returns in the high fours or whatever it is, right? With doing nothing.
Which may be what we want to do.
I would think so.
well, we are, as stuff matures, we're investing in the 4% range.
I think the one downside I would say in terms of aggregating it from a management perspective, it does make it probably your job managing our fund a bit more challenging when you have to keep in constant talk of where the balance of our portfolio.
I think we're asking Bob to understand. We need to understand.
We need to, yeah.
We need, Andy needs to present to us. So Bob does his thing.
Yeah,
That's a component piece of it. But it's not that, I think John's point is it's not the universal picture, and we need to have a view of what that universal looks like. And
Even if we just added the liquidity portfolio to the investment guideline mix
maybe a couple
of
slides.
equities,
A couple slides of
that's
that.
another $180,000-$200,000 of equity room potentially that.
We would manage them in separate portfolios. I'm only talking about consolidating them for reporting purposes. They would retain their identity.
Yeah.
And it
No, I
wouldn't
understand.
change the way we manage them unless you told us to change. the
We're
way
not
we
telling you
manage
to. We're just, it's more, I think John's point is there's seeing the
them.
forest
It's a
through the
bigger
trees.
world out there.
Yeah, that's all. So you get hung up on this and, we get locked into returns too, but we should also think about kind of cash flow. What's the cash flow? What's the income? What's the absolute income level? What's that doing? And how is this supporting on an absolute income level our operations? And that, Andy, maybe that's your world, not Bob's world. I don't know, but something to think about.
Well, we'll do that for next.
That's exciting.
You're easily excited, Andrews.
and Bob, we have you next week as well for the board meeting.
Yeah, not only you have me, but you have the A-team. You get Alicia.
Nice, good.
And so I don't want to cut sort of discussion short here, but we do have another guest speaker today that is waiting in the Zoom.
Great. Any more questions for Bob? Bob, we appreciate this relationship greatly.
Well, thank you, Andrews, and we really appreciate it from our side too.
Awesome.
We'll look forward to seeing you next week.
Excellent. Thank you so
Awesome.
much.
Yeah, thank you all.
Who's, what, is it the funeral at St. Mary's?
No, you not the cake.
See,
I can go. Big funeral at St. Mary's.
You'll see her yourself.
Next one of those questions I was asking for you, Don, because I don't think you.
Yeah.
Here's our investment policy
Yes.
guidance,
Yep.
whatever.
And we're in-
For, we're at 11% in equities, but that's 11% of that reserve portfolio, not of our full cash position.
But probably if you take the universe of public authorities, the number that have equity positions is close to zero.
Yeah.
Yes, there's a, it's a,
So we would be as in this today.
I don't know. Yeah. Do we have the need to vote on much today? We're gonna lose. Richard.
We will, review the real property report, we'll review the finance charter and procurement policy. I think those will take, positive recommendations or
We need
considerations.
recommendations. In the end, the board's gonna have.
But we have a quorum without Richard, right? So if we lose him, it's fine.
So we will, be looking for, a motion to enter executive session,
I'll move it.
to discuss matters related to the potential appointment of a particular person or corporation.
I'll move it.
Second,
Okay, so we're now in executive session.
almost.
have a motion to come out of executive session, right? Did we vote on that? And then we came out, we had executive session, we reviewed the proposal on the Clinton Market Collective, discussed operating strategies from their RFP. And at this point, we're ready to consider a recommendation for recommending this to the board and to Ashley to negotiate the contract according to the parameters of the RFP with modest modifications or recommendations from the finance committee. So can I get a
I'll make
motion?
that motion.
A second? Second. Okay, we have a motion and a second. Any further discussion? No, all those in favor? Aye, great. Carried unanimously. Or that's it. Where else, where are we on the calendar now?
All right, in public session, a couple of items we need to do today. I'm gonna do annual real property report first. That's really simple. We added 34 Hamilton to our property this year, and then we took away the collection of the Palace properties on North Pearl and Clinton. So as of 12/31/2024, this is the list of our property holdings. This is a requirement for us to review this annually. This will be also reflected in the annual parish reporting as far as the actual transactions that occurred this year.
What should we be considering relative to the railway station now? Anything is that 100% net lease? Is there any operating requirements there?
So triple net,
Triple net?
Right, right.
to Greyhounds. That's what.
Greyhound, I'm sorry.
Yeah.
That's
Yeah.
how I yeah. So yeah, triple net, we are working through some code corrections, with the site operator. But, they're responsible for that maintenance of cars.
Any liability risk or other specific ownership risk we need to be thinking about?
None that wasn't previously known.
Is there anything? I don't know, I'm kind of miming my way through it. We own a bus station. I don't know what you need to know to own a bus station.
So the good thing with that, even structure, the capital items, they're on there.
Right.
There's a little bit, 7-8 grand that we would potentially have to chip in this CAC, and I think they've already burned through that, and that was for a limited amount of time. So, presently, we're still month to month. So we're not long-term risk right now,
Right.
and that cuts both ways, obviously.
We gotta develop a longer term view of, I guess we have a long term view of so much of this is Liberty Park, but of that building and how are we gonna manage that process? And do we have a strategy around managing the process? So having a different place for that facility is important, right? And do we need to think about being part of the solution? We have the right to terminate that at some point, but that's a critical service to our region. And so we have a responsibility there of some level. What's our strategy?
The strategy right now is working through that short-term lease amendment that Greyhound has asked for. And then meanwhile, looking to see how we can incorporate into the agreement to make sure if there's any immediate term improvements to the structure that they could make, noting that, the status of the building may be short-lived, but working through those negotiations there. I think we had previously discussed at finance committee and the board, potentially extending, into 2026. So we'll be negotiating with that.
Is our discussions with the lease owner or the operator?
It is with the real property manager.
Do we know anything about the CDTA involved and what their long-term view is for the facility from a use perspective?
They had been part of the Kiernan project proposal there. So depending on, status changes with that proposal, we'll have to be in touch with them.
CDTA has done probably 6 or 7 studies on a downtown bus. Well, downtown bus station, CDTA, like regional transportation hub. Going back to like early 2000s, that I know we have available to us at the organization. And they range from like state of the art, large scale facilities to just
So
a
what's the current view
small
though?
bus station that like drop off facility.
So this is not a near-term solution, strategy to have a more whatever, connected, consolidated view of transportation and how this supports the region and
I mean, we're not in executive session, right?
No.
No.
So I mean, there's we do have transportation experts on the Stantec team. My suggestion is that we pull in those folks, and if not them, we go out and get our own who are completely familiar with what, you know, CDTA's role is in terms of transportation in this region, but could also advise us on, you know, should the bus station, in their opinion, should the bus station be going somewhere else? SUNY Albany, for example, or, you know, what is the right location for that facility? Who's using it? Why are we, you know, does it need to be right there? Could it be half a mile away and still perform its function? I think we can see from the Trailways temporary facility, that seems to be working. So, you know, you could drop one of those trailers anywhere. And maybe, you know, have a short-term fix while a larger, you know, facility gets built somewhere. I guess the question is, where should that facility be?
Yeah, and I think that's not a question that's gonna be answered today, but that's something this team can take on, working with CDTA and our partners on strategizing or,
you should
you
do
know,
that.
kind of identifying that. I think for purposes today, I do think we need a motion on the real property report, approving it as.
Motion.
Second, any further discussion? Hey, Ashley, just before you bring the one thing about to the proposal on the Clinton Market Collective, the CMC, is that what we call it now, the CMC?
Mhm.
The CMC, that's what their vernacular is. Just make sure you do a hard review of those references,
Mhm.
not the ones they provide, but if we know that they worked for the Lark Street bid, Sonia, and they've worked for the mayor and they've worked, let's make sure that we know what we need to know about there's no surprises.
We'll do that. And then next, order of business would be review of the finance committee charter. No proposed changes on the charter. The only, sort of recommendation from council was if there was any, inclination or anybody that wanted to change the minimum number of meetings, to 2 or greater. We're always in compliance, so I think it stands at 4 now. But that was the only thing that was.
Or for what, finance
4
committee?
yearly for finance committee is our
How
minimum.
many do we meet? How often do we meet?
We're meeting.
Every month, every month almost.
We're
There's
never-
no reason to change
Close.
that.
There's no statutory.
I think quarterly to make sense because I think you want to have at least quarterly financial reporting, so I think that makes sense to me, a minimum quarterly.
Okay, so then the charter would be reviewed and approved, and it's.
Do we need to vote on? A motion, please?
Motion.
Second. All those in favor?
Right.
Right, all right. And then you got procurement policy.
Same thing with procurement policy. You all did review this extensively in Q4 of 2024. We made a recommendation to change the thresholds by which proposals or procurement processes go to the board, as well as a change to allow for flexibility for one officer and one director to make recommendations on procurement selections. So with that, we would be reviewing the policy. There's no proposed changes at this time, unless the committee has anything they'd like to see edited.
Okay, get a motion, please?
Motion.
Second. Any discussion, any issues with, any functional issues, any administrative issues, management issues? Is it working?
No, it works great. With the
And we-
changes, it's working great, so.
And it captures the risk appropriately, in your view?
Yeah.
Great. All those in favor?
Aye.
Great. Opposed, carried unanimously. Great. What else do we need to talk about? Do we, and we went through that finance report. Do we review the policy annually? Like the financial policy? Does that come
The IPS
The
is,
investment
yes,
policy.
yeah.
Yeah.
I think it's April timeframe.
Yeah.
in April? Okay.
That's-
And then we
It's
can
not
think
yet.
about that, and then maybe, Andy, when you think about that, you should bring in to John's view, I think being able to see the collective.
Mhm.
Um. Assets, we see that in the financial report, but I don't know, just think through, I think what he's,
We can work on a consolidated presentation.
Yeah,
kind of a
just think
holistic one.
about it. And they can do a couple slides too, to combine the two and just to show how it is. All right, and then we talked about Clinton Market. Do we need to talk more about that?
Nothing, additional to talk about, Clinton Market today. The operating
Any
piece is the big
issues
one.
with operating maintenance? Is the maintenance contract working out okay?
Operations and maintenance are working great. I think the main key is getting it activated.
Okay,
That's
good.
our biggest liability at this point from, reputational as well as just,
There's no liability from like maintenance, trash, ice, stuff like that. That's being done well.
Yeah, so APA covers up to the first 2 inches, so our property manager will be going over there today to clear it out appropriately. And we're gonna take a look at signage, so when there is an intermittent closure due to snow, we can put up signage for.
But we do have
space.
periodic check-ins with APA just to make sure that everything is functioning as expected. No issues so
The
far.
garbage removal.
What's their reporting? Do they give a formal report?
APA?
Yeah,
No, we just check in monthly for maintenance,
that's it.
facility
Okay.
issues.
So are we, to Joe's question, really, I mean, are we targeting maybe a February 1 start date or something? If we get board approval on Tuesday?
I think that would be a tight turnaround on contract negotiation, so I think it'll be,
I mean, it's February, still winter.
I know, but the sooner they start, the better. in
Yeah,
terms
you're
of-
right.
Or for planning purposes. We
Yeah.
thought that we want to give them a runway to build up to a spring launch.
Yeah, spring will be here before.
When's Tulip Fest?
May.
All right.
Yeah, I mean, there's so many things that they could build
Kick off
around.
in the spring.
I'm already
Sure.
thinking like a Christmas, there should be a Christmas marketplace there.
Yeah,
Market,
yeah.
Up the Skyway,
Perfect. That'd be
some
fun.
lights and,
don't give away all our ideas.
yeah,
Someone will take it.
Sounds like fun.
and the beer trail, you just go right across,
Oh, beer trail, now you're,
just right up the Skyway, up
nice.
and down.
I like my idea of the Sphere, and Albany Sphere was
Yeah.
better.
Chatterfest, Chili Fest,
All right,
we could do those next month.
so Clinton Market's going well. How about Liberty Park? Where are we at?
Executive session.
No, we're on executive session.
Is there anything else before we go into executive session that we need to talk about in general session?
We did not go through, the 2024 unaudited and quarterly,
Any high level, things you wanna address?
From a high level perspective, the audit's ongoing. The year-end financials are positive if unaudited and approximate to date. Net, income before operating, 447,000. All inclusive, the all-in number is closer to 2.2 million after you factor in all our grant receipts and, kind of non-operating events. Revenue, 9% outperform, expenses 23% outperform. So we're controlling costs and looking for revenue opportunities where they exist. More to come.
Okay, any issues on the balance sheet cash flows that you wanna highlight?
We're working on some reporting refinements.
Oh, good.
We expect to have some more information available to the committee on an ongoing basis, but both BST and internal, we recognize that there's some opportunities there. And we are looking for opportunities with our operating accounts, interest rates and efficiencies there as well. So both from potential revenue sources and then additional fraud protections on the accounts.
Great. Any issues coming up in the audit process versus what's been reported to the board versus what Going to report and an audit, any issues there?
No anomalous activity. This is our first year. We have, not this
New
committee is
partner.
Bailiwick, but on the other side, we do have a new partner, so we're kind of onboarding each other at that point.
Yes.
No, UH1 is a great, great existing partner, and the new partner
For
is
sure.
shaping up well.
Okay,
So no issues to report.
all right. Well, I think it's exciting to beat budget always, but I think, and I commend the staff for extra work, but beating budget by not spending money is not a recipe for long-term success, right? So we need to create opportunities through spending money, delivering on initiatives, et cetera. So, but I recognize that being below in expenses is hard on everybody, and so I just want to say it's nice to see a positive outcome, and I recognize you guys our team has contributed to that, so thank you. Do we need a motion to approve the financial reports? We don't. Okay, but those are gonna get reviewed at the board, right? Okay, great. All right, so now we'll go into executive session. Okay, so we'll enter executive session to discuss what?
Potential disposition of real property, publicity of which would affect the value.
And ongoing litigation.
All right.
I'll make that motion.
Second.
Okay. So we had executive session, discussed, real estate matters relative
We
to.
gotta wait till you come out.
Okay, so we're out of executive session. We, discussed, no actions were taken, and we discussed real estate matters of a confidential nature. And now we're back in the original session, or general session.
Motion to adjourn?
Motion, get a second?
Second.
All in favor?
Aye.
Aye. All right, so where did that leave?